Will America go broke under President Trump? Foreign investment in the US is on the verge of a historic exodus. Bank of America has sounded the alarm. Up to $41 trillion in foreign-held US assets, the very foundation of American economic power, is at risk of fleeing. That's not a minor shakeup. It's a financial earthquake waiting to happen. Stocks, bonds, real estate, and reserves all hang in the balance. This staggering figure eclipses the entire US GDP multiple times over. What will happen if the global money spigot suddenly shuts off and the world turns its back on the US economy? Can America withstand the fallout from the biggest capital flight in modern history? Hello and welcome. You're watching Statecraft with me, Geeta Mohan. This isn't a distant threat or vague speculation. By early 2025, foreign investors had already withdrawn $6.5 billion in just 1 week, while an additional $8.9 billion in investments stalled, frozen mid-air by growing uncertainty. Why this rush to exit? Political turmoil, unpredictable trade policies, soaring national debt topping $37 trillion, and powerful global players quietly selling off US assets have shattered the confidence investors once had. $41 trillion figure represents real holdings across stocks, corporate and government bonds, real estate and reserves, roughly a third of these markets. How did the land of opportunity become a minefield for global capital? At the heart of this crisis is a growing perception that the US is no longer the stable, reliable haven it once was. President Trump's re-election in 2025 marked a turning point. His administration doubled down on tariffs, slapping import duties of 10 to 50% on goods from over 60 countries, including allies and major trade partners like China, India, the EU, and Mexico.
When you look at how the U.S. has approached with making a lot of these threats, the challenge is that the shock value of these threats continue to diminish every time a threat comes, but it isn't executed upon. So what you really need for credibility is that you have to have some clear plan, some enforceability along that discussion path as well. But of course, we can't underestimate the U.S.'s ability to continue to add more shock value in more threats going forward. So I suspect the type of leverage the U.S. has, certainly as the largest consumer market in the world, will continue to be a factor that'll cause other countries to think cautiously. My guess is we'll continue to have an extension going forward, at least until Xi and Trump have a way to meet each other one-on-one. But even after that, after they've set the tone that negotiation is still in the cards, we'll probably continue to see different levels of extension, maybe by sector, maybe by tariff categories and so forth. But the negotiation will continue extensively because the issues are so complex. As we're looking at a more volatile trade environment right now, the reshoring, the supply chain diversification will continue onwards, but it may not accelerate as fast as it used to be, primarily because the multinationals that have already diversified their supply chain probably will not need to continue to do so. I think what we may see, which is actually against the trend, is that we might start seeing some more reshoring back to China. Generally, when you're looking at reshoring, ideally you're going to be closer to where your target customer market is. But if you're looking at it purely from a cost standpoint, looking at it from the ability to create new products rapidly at a cheaper cost, then the appeal of China is going to start looking stronger over time in a world where every country is facing higher and higher tariffs and greater uncertainty.
The stated goal? To force foreign companies to build inside America and rebalance trade. Reality? Retaliatory tariffs, disrupted supply chains, higher consumer prices, and an investment environment riddled with uncertainty. In an era where capital demands certainty, how can investors bet on a market where the rules change overnight?
So, if you look at that, China, first row, China 67%. That's tariffs charged to the USA, including currency manipulation and trade barriers. So 67%, I think you can, for the most part, see it. Those with good eyes, with bad eyes. We didn't want to bring, it's very windy out here, we didn't want to bring out the big charts because it had no chance of standing. Fortunately, we came armed with a little smaller chart. So it's 67%, so we're going to be charging a discounted reciprocal tariff of 34%. I think, in other words, they charge us, we charge them less, so how can anybody be upset? They will be, because we never charge anybody anything, but now we're going to charge. European Union, they're very tough, very, very tough traders. You know, you think of European Union, very friendly, they rip us off. It's so sad to see. It's so pathetic. 39%, we're going to charge them 20%, so we're charging them essentially half. India, very, very tough, very, very tough. The Prime Minister just left, and he's a great friend of mine, but I said, you're a friend of mine, but you're not treating us right. They charge us 52%. You have to understand, we charge them almost nothing for years and years and decades, and it was only 7 years ago when I came in, we started with China and charged them. We took in hundreds of billions of dollars from China in tariffs, and they understood, honestly. President Xi understood. He said, look, I understand, and the other countries, and they all understand. We're going to have to go through a little tough love, maybe, but they all understand. They're ripping us off, and they understood it. Prime Minister of Japan, Shinzo Abe. He was a fantastic man. He was unfortunately taken from us, assassination. But I went to him and I said, Shinzo, we have to do something. A trade is not fair. And he said, I know that, I know that. And he was a great gentleman. He was a fantastic man, but he understood immediately what I was talking about. I said, Shinzo, we have to do something. He said, I know that. And we worked out a deal, and it would have been a much better deal, but frankly, there were many years left on the deal that was made previous to my getting there, but it was something.
The unpredictability doesn't stop at tariffs. Trump's tax policies, while lowering corporate tax rate to 21% and promoting US-based research and development, introduced clauses like Section 899 that threaten retaliatory taxes on foreign income. These moves send mixed signals, offering incentives on one hand while threatening penalties on the other. Meanwhile, the administration's massive spending spree promises trillions more in debt, shaking the confidence of those who lent America money. The federal deficit is ballooning, raising questions about America's fiscal sanity and the sustainability of its borrowing. When Washington's economic compass spins wildly, why should foreign investors hold steady? Trump's battles with key institutions exacerbate the chaos. His public attacks on the Federal Reserve and efforts to undermine its independence raise red flags about US governance. The America First doctrine signals a retreat from multilateral cooperation and a willingness to sacrifice established alliances and investor protections for domestic political gain. This volatile political backdrop makes the US look like a risky bet, prompting global investors to hedge their bets elsewhere. If the government itself appears unreliable, what hope is there for restoring faith in the financial system? The $41 trillion at risk isn't just abstract finance, it's the engine powering America's economic might. Foreign investors hold about 20% of US equities and a third of government and corporate bonds. Real estate in key cities, New York, Miami, Los Angeles, depends heavily on foreign capital. The tech sector, AI, biotech, and green energy industries also rely on this inflow for innovation and jobs. If foreign capital withdraws, stock prices and bond values could plunge, interest rates would soar, and millions of retirement accounts could evaporate in value. The consequences would ripple through every corner of the economy, from Wall Street to Main Street. How long before this silent hemorrhage becomes a full-blown financial crisis? Adding fuel to the fire, major players like China and Saudi Arabia are quietly unloading their US holdings. China has dramatically cut back on treasury securities, the backbone of US debt financing, while Saudi Arabia quietly reallocates assets. This reflects a strategic recalibration in response to political tensions and fears over the dollar's future. Central banks worldwide are rebalancing reserves, moving away from the dollar toward euros, yuan, and gold. The dollar's share of global reserves is sinking to multi-decade lows. Once the world's unchallenged reserve currency, the dollar now faces an existential test. Can the US maintain its financial dominance when the global system itself is de-dollarizing? The rise of the national debt is a critical worry for investors. At $37 trillion and climbing, it dwarfs previous records. America's creditworthiness, once considered rock solid, now faces growing skepticism. If investors lose faith in Washington's ability to manage its debt, they will demand higher interest rates to compensate for risk, driving up borrowing costs for businesses and consumers alike. Higher interest rates threaten economic growth and jeopardize federal programs, further fueling instability. How much longer can America borrow without triggering a financial tipping point? The human cost is staggering. Key sectors fueled by foreign investment, manufacturing, technology, biotech, face job losses if capital dries up. Cities that thrive on international real estate investment risk housing market crashes and falling tax revenues. Inflation could surge as a weaker dollar raises import prices, squeezing American households already stretched thin. Retirement savings invested in stocks and bonds could take a beating, threatening the financial security of millions. This isn't just a Wall Street problem, it's a crisis that would touch every American family. What happens when the economic lifelines disappear? At its core, this crisis reflects a fundamental shift in the US's role in global economic order. Trump's aggressive America First policies prioritize domestic political gains over predictable, cooperative economic governance. This has alienated allies, increased trade tensions, and fostered an environment of policy whiplash that global capital simply cannot tolerate. Investors crave stability and clear rules. Instead, they get uncertainty and unpredictability. As capital flows shift to emerging markets and friendlier financial climates in Asia and Europe, America risks losing its economic throne. Can the US reverse this drift before it's too late? Rebuilding trust won't be quick or easy. It demands credible, long-term commitments to stable fiscal and trade policies. The national debt must be controlled, tariffs rolled back, respect restored to institutions like the Federal Reserve, and diplomatic bridges rebuilt with allies and trading partners. Investors and businesses need clarity and consistency to feel safe again. Diversification away from US assets is already accelerating. Supply chains must adapt to new geopolitical realities. The scramble for alternatives to the dollar is a clear warning signal. America's financial hegemony is no longer guaranteed. Can policymakers rise to this daunting challenge? Bank of America's $41 trillion warning is more than a market forecast. It is a flashing red beacon highlighting the vulnerability of America's economic foundation. The perfect storm of political instability, policy unpredictability, rising debt, and geopolitical realignment threatens to unravel decades of financial dominance. The stakes couldn't be higher. The future of the dollar as the global reserve currency, the stability of financial markets, and the economic well-being of millions of Americans all hang in the balance. Will the US respond decisively, or will history record this moment as the beginning of America's economic decline? The fallout from a capital flight of the scale would extend far beyond markets. Retirement funds, pension plans, and individual savings would take a massive hit. Interest rates would surge, increasing borrowing costs for everything from home mortgages to business loans. Job losses would mount in sectors dependent on foreign capital, from cutting-edge biotech firms to traditional manufacturing hubs. Inflationary pressures from a weaker dollar would squeeze consumers, raising prices on essentials. In short, the economic ripple effects would be felt in every household and community. How prepared is America for this economic reckoning? Emerging economies in Asia, Europe, and elsewhere are ready to seize the opportunity. Countries like Vietnam, India, and Malaysia are already attracting capital fleeing the US, promising more stable investment climates and friendlier trade policies. European and Asian governments are rolling out incentives and infrastructure to capture redirected capital flows. New trade agreements and alternative payment systems are eroding dollar dominance. The global financial architecture is shifting beneath America's feet, and the question remains, will the US act quickly enough to reclaim its position or watch power slip away? The speed of this capital flight is staggering in today's digital world. Trust dissolves overnight and investment decisions are made at lightning speed. High-frequency trading and algorithm-driven portfolios amplify outflows, turning confidence crises into market crashes in hours or days. The question is no longer if the capital will leave, but how fast and how far. Will America's financial system withstand this rapid unraveling, or will it buckle under the pressure of a $41 trillion investor exodus? Bank of America's stark warning about $41 trillion in foreign investment at risk is a wake-up call to America's leaders and investors alike. It signals a profound crisis of confidence rooted in political unpredictability, rising debt, and global geopolitical shifts. The US stands at a crossroads. It can choose to stabilize its economy, restore trust, and reaffirm its global financial leadership, or it can watch as capital flows dry up, markets collapse, and its economic influence fades. Which path will America take? Thank you for watching Statecraft.